What's the number one barrier to progression in either your career or your business? Over nearly 30 years, I've seen an awful lot of people who, when you talk about financials, this is their reaction: confusion. They just don't understand where the data comes from. They don't understand the numbers that they're looking at and what they're telling them, and therefore they're not able to make informed decisions or to provide insight. Over this and a series of videos, I'm going to help you to understand why that is, but also be giving you some real practical tools and tips to help you to make that progression in your career or in your business. Join me on the route to financial empowerment. First things first, why is it that people struggle so much with understanding financials? Well, firstly, the format of financial information, the format of accounts, is designed by accountants for use by accountants. It's not designed for the layman. It's not designed for someone that doesn't have that technical level of understanding. It's not made easy. Secondly, the world of finance and accounting is absolutely awash with jargon and terminology, whether it's EBITDAs, accruals, prepayments, provisions, whatever it is, we've got a term for it, and in fact, we've probably got several. There are all sorts of things in the financial world where we don't just use one term to describe it, we use multiple terms, we use them interchangeably, and just to make it even more complicated, we don't tell you that that's what we're doing. Thirdly, there's a level of presumed or assumed knowledge. Lots of people I see are just not confident. They daren't speak out. They think that they should know these things, when in actual fact, there is absolutely no reason why you should know or understand things that have never been shown to you. Next, some of the key concepts are just not obvious. They don't make logical sense unless you really understand why accountants are trying to do what they're trying to do. And finally, and massively important, lots of the information is subjective. It's not instinctive. So there's been subjective principles, subjective assumptions applied that impact the information that you see, whether that's the recognition of revenue, the recognition of cost, the recognition of profit, the valuation of things, the timing of when things are recognized and how that differs from the timing of when actual cash transactions happen. It's subjective. It's not instinctive. And in these series of videos, I'm going to help you to make instinctive financial decisions. So what it means is that you can understand what financial data is showing you. Understand what data to ask for, and that's one of the biggest challenges for people, is because they don't understand what they're looking at, they don't know what they're not seeing. They don't know what data to ask for to help them to make better decisions. And if you don't understand what you're looking at and you don't have the right data, how can you possibly understand what levers you need to pull in order to improve financial performance? I will help you to develop real financial intuition so that this decision making is just as intuitive as all your other decision making in your business. And that will result in you having clarity, enable you to make good decisions, and create that progression either in your career, in a corporate environment, or as a business owner or business leader in an SME environment. At the heart of your financial information are three financial statements: the profit and loss account, the balance sheet, and the cash flow statement. And you'll see around the outside of the diagram there's three little symbols. They're designed just to help you understand a little bit about the nature of what each of these things do. And I'm going to go on to talk about it a little bit more. So the profit and loss account, it's like a video or a DVD. It tells you all the things that you've been doing operationally during a given period of time. So in the formal accounts, that's over the course of a year. Whereas the balance sheet, it's like a still photograph. It's a snapshot. It shows you certain things, but at a given specific point in time. And then last but not least, the cash flow statement is like a CCTV camera. It shows you how much money has come in and gone out of the business in cash, in actual money. And that's different to the value of things that you might see in your profit and loss account. So what do these things show you and what don't they show you? Well, the profit and loss account, let's start there. It's the one that's most familiar to most people. What it does show is your creation of value in your business. Are you creating long-term and sustainable value? It does that through showing you what we'd call margins or profitability. And you'll hear lots of terminology about profit. You'll hear things like gross profit, gross margin, operating profit, operating margin, EBIT, profit before tax, profit after tax. They're all subtly different. They all show you and tell you slightly different things about the performance of your business. What that does is it highlights the impact of the mix of what you do. Are some things more or less profitable than the others? And what volume are you doing those things in? And therefore, what impact does that have on your performance? It also shows you the impact of scale. So the relationship between your cost base and how that changes as you get bigger versus your revenue and your profitability and how that changes as you get bigger. That's on there too. And that, in turn, can help you understand the effectiveness of the pricing of the things that you buy and sell. Furthermore, it shows you where and how you incur costs in your business. But what it doesn't show you is the value of resources that you've got in your business. It doesn't show you the value of the equipment that you've got, the infrastructure that you've got. It doesn't even show you the value of stock if you have stock. It doesn't show you how much cash you've got in the bank. Profit is not the same thing as cash. It doesn't show you when and how you're investing. It doesn't show you where you've invested your money or who's invested in you. And it doesn't show you what debt, if any, the business has. Whereas the balance sheet, it does show you where the funding came from for your business. It does show you, is the business solvent, both in the short term and in the long term. It does show you something that we call working capital, so the availability of funding on a short-term basis to do the things that you need to do. And it does show you the value of your resources, the value of your infrastructure, the value of your stock. So it shows you your infrastructure and it shows you your relationships. The relationships that you have with suppliers, but also with your customers and what value they have. The balance sheet, though, doesn't show you company value. You can't get a company value from a balance sheet. It doesn't also show you what those balances would be tomorrow or next week or next month or next year. It shows you them at that point in time. It doesn't show you, unless you've been sold, unless you've been acquired by another business, it doesn't give you a value of the goodwill that you have. How much does your reputation matter? How much value does that have? Your position on the high street, where you're based, who you've got relationships with. It doesn't put a number on that. And it doesn't show you the value of your people and their processes. Cash flow and the cash flow statement, what that does show you is where the cash came from. Was it how much came from customers, how much came from investment, how much came from borrowing? And it also shows where the cash has gone to. Paying suppliers, paying taxes, paying people. Where have you spent your money? It shows the repayment of debt. And it shows the value of your supply chain. It also shows if you've made any investments. What have you done with your money? But what it doesn't show you is how much cash you're going to have tomorrow. It doesn't show you the value of what we'd call non-cash items. So things, you might have heard the term depreciation or amortization. These are examples of non-cash items. And that's where we reflect costs that don't align with payment. And it doesn't show the impact of what we call accrual-based accounting. This is the fundamental principle that dictates why we show what we show and when we show it. And it doesn't show the future requirements for cash. So that kind of information, what cash you need tomorrow, where it's going to come from, what payments you're expecting to receive, that might be part of a cash flow forecast, but it won't be part of your formal financial statements in a cash flow statement. So, as you can see, lots of information, lots of different things on these financial statements, and over the series of videos, I'm going to be giving you tools and techniques so that you can understand where that information has come from, and crucially, therefore, how you can use it, how you can make your decision-making intuitive and instinctive.